Hello and welcome to Off the Books, where we surf the uncharted waters of accounting, finance, risk, and wherever else the waves take us. This episode is brought to you by Workiva, the one platform that brings financial reporting, ESG, audit, and risk teams together like a five-way tie for first place in the Big 12. My name is Steve Soder, accounting enthusiast and Diet Coke aficionado. Looking forward to debating a great conversation, and I'm so happy to have you with us. And I am also so happy to have Catherine Tsai joining us. Catherine, can you introduce yourself?
Yeah, I'm not an accountant or Diet Coke aficionado, but I like asking questions of smart people. So I'm here to ask questions of you, and especially our special guest today.
No kidding. So we have Nick Mazing joining us back again. Nick, you have been on the podcast multiple times. I'm wondering if you could tell us about that, as well as remind our audience about your role and the company you work for.
Oh, well, thanks for having me back. I heard that you're rolling out a guest loyalty program, so once I get my 10th appearance, I'll get that plastic Workiva water bottle I've always dreamed of having.
Sorry, Nick, that's 20 episodes.
Oh, well, already starting the call with a loss. Well, let's go. More seriously, I really enjoy chatting with you every once in a while. I think you have one of the most informative podcasts in the corporate finance space, and if you haven't heard me here before, I'm the Director of Research at AlphaSense. We're a AI-powered market intelligence platform, and we bring in one place corporate documents like filings, transcripts, press releases, regulatory content from the SEC, FASB, and so on, Wall Street research documents for the Big Four, expert interview transcripts, and so on. So specific to SEC reporting teams, we're the go-to place for searching across peers, look at in-depth accounting interpretations, and so on. And we had a great year. We just announced our Series E. Google invested in us in April in our Series D extension. We're rolling out Gen AI products, 3 already this year, so certainly an exciting time for us.
Humble brag. I know it's been a while since we chatted. We wanted to check in with you and ask you about what sorts of trends you're seeing in Q3. What would you say were the top 3?
So this earnings season, there are really 3 things that stood out. Number 1, generative AI. Number 2, the diet drugs. And number 3, the situation with the interest rates. So taking those in order, starting with generative AI, there is an absolute explosion on conference calls. And last year, in the final quarter, the calendar Q4 of last year, there was only 13 transcripts that mentioned generative AI. In the last full quarter, which would be the calendar Q3 of this year, there was 877 of those. In other words, it was a 70-fold increase in transcripts that mentioned generative AI. So it's certainly one of the biggest waves in technology ever. And you're seeing that in the market as well. There is the Magnificent Seven, which is the kind of the currently perceived as AI winners, where the stocks are doing very well. And without them, actually, the stock index year-to-date is not doing as well. The second topic is the new diet drugs. By now, everyone has heard of Ozempic and Wegovy, but there are more in the pipeline. So first-order effects are very obvious. So if you look at Novo, you look at Eli Lilly, big pharma companies, they have benefited from these. So these are the haves. You also have a lot of scrutiny of the have-nots. So there was a Wall Street Journal article last week where they looked at another large pharmaceutical company. It's like, investors are wondering why they don't have a diet pipeline, right? So the second-order effects are more interesting. So we're seeing weakness in medical devices, so things like glucose monitoring, because the expectations are there will be less demand for things like glucose monitoring. There is also an expectation that bariatric surgeries will go down because these drugs are so effective. On the flip side, there is an expectation that you may see more cosmetic surgeries, things like skin tightening and so on. Most interesting to me, there was a downgrade recently where a Wall Street analyst downgraded a coffee and donut chain specifically because of the diet drugs, which is very, very interesting. And also Wall Street is running a lot of reports with surveys of people on those drugs and what kind of foods they're cutting back on. So, Steve, is it material if Wall Street cares about it? Because I know that after Diet Coke and Crocs, materiality is one of your go-to topics.
It is one of my go-to topics, and I actually found that so interesting when I read about that downgrade, because I've got to believe that this is something that specific company is paying a lot of attention to. I would imagine that large food manufacturers are also paying a lot of attention to it. And what's so interesting is that you could actually have a downgrade, which I would say is absolutely material to investors, because, I mean, that's going to directly impact the stock price. Yet meanwhile, inside those very companies, I wouldn't be surprised if there's a real lack of data and support for decreasing revenues or other things in support of that downgrade. And that becomes a really interesting disclosure question. You have downgrades that are public and will cause, again, some impact to stock price, yet there may not be any large amount of evidence or data internally to support any kind of a disclosure. And so now, from an SEC reporting perspective, it probably would make sense to talk about it. But I'm thinking specifically about risk factors. Let's just say, like, hey, we're not noticing anything changing in our results of operations in response to these things, but it might. It is being talked about. And that, to me, is the difference between something, again, that may go in a risk factor as opposed to something that may actually end up, in your MD&A. I would say that this isn't that different from broader ESG issues where investors might be talking about it, but there may be a lack of data inside the company to start to make those connections. I think that puts financial reporting and, for that matter, ESG and sustainability teams in a pretty difficult position when you're trying to figure out, okay, how do we talk about this publicly?
Mm-hmm. And I did look at companies outside of the healthcare sector in their risk factors, whether they've been mentioned diet drugs, and the answer is no. So excluding healthcare, which obviously the number of companies discuss them, when you look at 10Q risk factors or 10K risk factors, depending on the year, I did not see anything that is mentioned there related to that. I think that will change. So, for example, generative AI, the other topic, is now all over risk factors in many different contexts, including one technology company is discussing that companies being slow to adopt generative AI may hurt them. And then we have all kinds of other risk factors, copyright infringements and, general business displacements and so on, which I think is very interesting. But the diet drugs are not in the food companies' 10Q risk factors yet. But when you look at stock prices and things like that, there is a number of 52-week lows in the last few weeks, and people think that they're being affected by that.
And I mean, not to interrupt you, but that's super interesting to me, Nick, because that feels like a bit of a miss. That's what risk factors are for, actually, is to think about kind of the what ifs. I mean, you don't want to throw everything in there. The SEC has tried to shrink the amount of risk factors and make it way to 10Ks, but that feels to me like a perfect opportunity to say, hey, we're paying attention to it. It hasn't impacted our results, which is why we're not talking about it elsewhere, but it's something that's on our radar, which is why we put it in a risk factor. I don't know. Maybe you put it in a risk factor and it legitimizes it, and they don't even want to do that. I don't know.
Yeah, and analysts are asking about it on calls as well, right? So it is a little bit of, I think we're still in the uncertainty zone on that. And then the third topic that is certainly very big, and not just during this earnings season, is interest rates. And, if you're new to the game, we had abnormally low interest rates for more than 10 years. And now we have seen a very rapid increase in interest rates. So not only did they get high relative to recent history, but also went up very quickly. And these fast moves tend to break things. So you look at the bond market crisis in 1994, you look at the dot-com bubble in 2000, you look at the great financial crisis with the real estate bubble, 2007, they all had rate hikes, right? So we're already seeing the housing market freezing because of that, specifically existing home sales. Everybody who has a mortgage, 3% is not moving, right? And when you look at the numbers, it's completely frozen, right? The number of sales there. But when you look at the transcript trends from the earnings calls, we're also seeing companies discussing things like maturity walls. We're seeing things like interest income is back as a topic since companies are earning more money on their cash balances. There was a food company that they had to refinance their 5% bonds that they had issued in 2018 recently. They refinanced those bonds at 8% and had to issue some equity. So their earnings per share gets a double whammy from, number one, higher interest expense from 5 to 8, and there was more shares outstanding, right? So this is a direct effect of the higher interest rates hurting earnings per share. The last thing that I would say there was a chart recently, it was either a Goldman report or a Bank of America report that looked at upcoming maturities for S&P 500 bonds and Russell 2000, which is the small caps. The S&P 500 maturities are extremely well spread out up to and including 2050, right? They use the period of low rates to term out their debt. On the other hand, when you look at the smaller companies, the vast majority of the maturities are in the next, call it 5 years, 6 years or so. And the market, I think, is worried about it when we look at the large caps are doing much better, at least this year, last year, versus the smaller caps in the United States. And I really think this is rates. So we're seeing a lot of focus on what's going on with rates and upcoming maturities and so on.
Well, let's hope you're not foreshadowing a credit crisis 5 years from now.
Once I hit my late 30s, I knew I had a serious decision to make. I could either get weirdly into World War II history, learn an absurd amount about wine, or start collecting vinyl records. Since I was never one for memorizing facts, and I think wine is best paired with, well, more wine, I started collecting albums. And yes, dear listener, the feel of a tactile piece of music is great in your hands. And yes, the sound really is warmer with all the pops and crackles underneath as Fiona Apple or Tom Petty warble through my apartment. But record collecting is complicated. First, there's choosing a categorization method. Do you go straight alphabetical or split by genre or year? And what if people you live with don't care about any system and like a monster they put Orville Peck's Pony right next to A Tribe Called Quest's Low End Theory? Then there's tracking album prices. They can fluctuate more than the stock market. You have to know where and when to buy that Carly Rae Jepsen you've been coveting. I wish there was a Workiva for vinyl, a unified platform to put all that vital financial reporting, ESG, and audit and risk info in one spot, and know what the most up-to-date facts and figures are. Dashboards to help you understand where your albums are by genre and year, and linked numbers and narrative to track a musician's career as they hop through various bands. Wouldn't that be great? Doesn't that sound lovely?
Nick, I did want to ask, since the SEC adopted a final rule on cybersecurity disclosures, I was going to ask if any companies have started making any disclosures about cybersecurity incidents yet.
I do have an alert set up for that 8K item 1.05, which is the specific type of 8K for cybersecurity incidents. I have not seen one coming yet, but back to materiality, if you adopt the framework from a few years ago, it was a VC that wrote software is eating the world. In other words, software is becoming more and more important. Breaches become more material, right? And just in the last few weeks, we saw very serious operational disruptions with a consumer packaged goods company and I believe 2 Las Vegas operators of casinos. These were ransomware situations. On the regulatory side, you're seeing much heightened focus by the SEC on cybersecurity. So, for example, there was a data breach and some employees sold stock ahead of that. They were charged with insider trading for avoiding losses. More recently, I should say very recently, there was another technology company that was charged alongside with their chief information security officer for fraud and material weakness related to a data breach that ended up being kind of a geopolitical sort of situation because I believe they were used by certain government agencies. So it makes sense to have special and prompt disclosures just because the importance of technology overall is much greater.
And, because the disclosure itself is very quickly becoming mandated vis-a-vis this SEC rule, you could even have all of the right controls inside of your company, but for lack of disclosure, you end up getting hit with a control failure because that itself was one of the things that then needs to happen. And when I read that case about that CIO being charged personally, that should be a really, really big wake-up call. I mean, there's, as you said, all kinds of other geopolitical considerations there, but that should definitely be a shot across the bow for CISOs and CIOs and others who I think now have a very personal stake potentially in getting this right in, the unfortunate event of a cyber breach. So one interesting thing, Nick, we're getting really close to Black Friday. In a previous Q3 earnings recap, you actually were able to share some Black Friday deals that you learned through your software. We're just curious, as we're all thinking about the holidays, anything to share on Black Friday at this point?
Well, can we talk about the pumpkin spice season instead? What do you think?
Sure.
I have very important information about
full disclosure. I'm not a huge fan of pumpkin spice, but this will make for great spicy podcast conversations. So yes, please.
So number one, it's not your imagination. I did look back And pumpkin spice season used to start in, October a few years ago. This year, 7-Eleven went out August 1st with their press release. And then Krispy Kreme was second. Last year, Krispy Kreme was first during the first week of August. I track all the pumpkin spice products that are released. So some notable things was a pumpkin spice creamers from Chobani. There was the Häagen-Dazs pumpkin spice ice cream, Wendy's Frosties, pumpkin spice as well. In case you don't know the Frosties, these are soft serve ice cream based beverages at Wendy's. On the crazier side, we had pumpkin spice caviar, which is made from avocado oil. These were these little pearls that were made into pumpkin spice with like a real caviar jar. Hormel released pumpkin spice ham. A little bit disappointed because if you remember a few years ago, they had the pumpkin spice spam that was sold exclusively on Walmart.com and sold out in 20 minutes. So
Have you tried either one?
No, I couldn't. But it was a little bit of a letdown not to have the spam this year. And you also had hefty trash bags that some are mint flavored and so on. They actually had pumpkin spice garbage bags.
No.
Doesn't seem real.
What planet am I on? Like, what is happening with the pumpkin spice?
That leads us to a pretty good closing question for today then. Nick, is there something that you think needs to be in a pumpkin spice edition?
Absolutely. I think when you look at the pumpkin spice economy, it's very, female dominated. So I think there's an opportunity in men's and maybe Old Spice, pumpkin spice, antiperspirant, and with my girl Britney Spears being back in the news with the biography after the conservatorship, there's all demand for kind of nostalgic pop, so maybe they can bring back the Spice Girls to promote them. So imagine this is Posh Spice for pumpkin spice, Old Spice, very catchy, right? So if you're a product manager at Procter & Gamble, this idea is available to you royalty free. So
very, very well played, expertly done, Mr. Mazing. Oh, my goodness.
Steve, I'm curious what your answer is.
None of it. Absolutely none of it. Nothing needs pumpkin spice. You know what? I will tell you this. My wife makes delicious pumpkin bars with cream cheese frosting. That's kind of a fall-winter thing. Nick, I think you've told us previously that you try to watch your sugar, so there's a lot of sugar in these things. You may want to avoid them. To me, Catherine, that's it. That's it. Full stop. A pumpkin pie, but I don't consider that to be a pumpkin spice thing. That's like a legit thing. So as far as I'm concerned, none of it. But how about you, Catherine?
I am really going to make a push for a pumpkin spice edition of Off the Books. Do you think we can make it happen?
I don't know. I'm not sure what reaction our producer Mike is having as he's listening to this conversation, but Mike, we should add that to our next staff.
Well, at the next Amplify, you can hand out cards with the QR code for the podcast and a scratch and sniff pumpkin spice. So that's your business card for the next Amplify conference.
Full of ideas. Well, Nick Mazing from AlphaSense, it is so good to have you. Thank you so much for bringing the research and bringing the spice, such as it was. It's always great to have you.
My pleasure.
And thank you, dear listener, for surfing along with us. I'm Catherine Tsai. You heard Steve Soder, and this has been Off the Books presented by Workiva. Please follow us wherever you listen to your podcasts. Leave a review. Tell your buddies if you liked the show. If you're watching this on YouTube, drop us a note in the comments or feel free to drop us a line at offthebooks@workiva.com. Surf's up, and we'll see you on the next wave.